A very good morning, friends. So I hope you're all doing well. So today we are going to do a very simple standard. I guess we had a discussion on Ind AS 1 where we talked about balance sheet, we talked about the income statement, but I think there is another one element of financial statements, which is cash flow statement. Though, if you look at Schedule 3, it does not talk of a cash flow statement. The format is typically given for a balance sheet as well as for an income statement. And there is a separate standard which is devoted to cash flow statement, which is Ind AS 7. I know the very first question which would be coming to your mind is, so we have already done cash flow statement at the intermediate level. So is this standard something very different or is this something similar? Well, I would say it is almost similar. If you look at Accounting Standard 3, what you've done at the intermediate level, and Ind AS 7, what you're studying at the fine level, is almost absolutely similar. You may not find much changes, but I am definitely going to change a little perception the way you handle a question on a cash flow statement. So what I'm basically going to do, I'm going to give you a very simple step-by-step procedure so that you don't go wrong in terms of making a cash flow statement. Well, I think if one needs to get more expertise in terms of making a cash flow statement, I think the main art is understanding how to make ledgers. Yes, you heard me correct. Because I think making a cash flow statement is getting a little more expertise in terms of making, I would say, ledger accounts. I believe, I trust that all of you have, very comfortable in terms of making ledger accounts because there are a variety of accounts in the balance sheet of the company, and we need to be comfortable in terms of making ledger. So, but before we go on to the art of making a cash flow statement, we are going to basically, I would say, revive the concepts in terms of what you've done in Accounting Standard 3. So we're going to start with some basic scratch, but of course, your understanding on cash flow statement, prior understanding, I would say, is going to be, of course, of great help. Because you've done this, I think, in financial management also, you've done this in advanced accounting also. So you're quite, I think, comfortable in terms of cash flow. Though I understand, my experience tells me, that generally people do falter in terms of making a cash flow statement. So no worries, today we are going to become a little experts in this area, but this chapter, of course, demands a practice as well. And I'm sure you're going to do that once the chapter gets completed. So let's begin the journey. So we are starting with Ind AS 7. And the name of the standard I've already said is called a cash flow statement. It is called a cash flow statement. Generally, when I look at any standard, I start first looking at the name of the standard. Whenever I look at any standard for that matter, I generally have a habit of looking at the name of the standard and analyzing the name of the standard, which gives us a lot of understanding about the standard. So as I look at the name of the standard says cash flow statement. So I can see that there are a total of 3 terms in the name of the standard. The first word is called cash. So immediately the question what comes to my mind is, what is cash? Now you would say that's quite funny. We all know what is a cash. But when we look at the cash from the point of view of a cash flow statement, it's not just cash. If you look at the meaning of cash, the standard says that cash is supposed to be cash and what we call cash equivalents. Well, as the name is cash equivalents, I would say in simple words, something which is as good as cash. So when we use the word equivalent, it means cash jaisa. So you can say something which is as good as cash. Further, if I apply my mind, when I say it is a cash, I would say number one, it is cash in hand. So when I'm looking in terms of cash, I would say it is cash in hand. It is also supposed to be a cash at bank. So when we're looking at cash, we're looking at both the cash in hand and we're looking at the cash at bank. Now, there is another question which comes to the mind of a lot of people. Sir, I'm always confused in terms of the treatment as far as a bank OD is concerned. So let me tell you that as far as Ind AS 7 is concerned, it is very clear in terms of how you're going to treat the bank overdraft. And if you may see the study material also, it's made a very clear-cut mention and given the inputs on a bank OD. I would say you need to see that bank OD generally, I'm saying generally, is repayable on demand. Because when the bank would give you, let's say, an overdraft facility, it is not something which you can enjoy till ever. It is definitely something which the bank can always tell you that it is repayable on demand. Unless mentioned otherwise, we are going to safely assume that the bank OD is repayable on demand. So when you are going to consider the cash, it would include a negative cash as well. And I would say the negative cash is like a bank OD. But you need to consider this bank OD on the presumption that it is repayable on demand. So if it is not given that it is repayable on demand, you're going to assume it that it's repayable on demand. So that's what we're going to consider. Okay, I think somebody said, sir, it's statement of cash flows, not cash flow statement. It doesn't make a difference whatever you call it. You call it a statement of cash flow or a cash flow statement, that's one and the same thing. That would not change the meaning of the standard. Okay. So in this particular case, we said it's cash in hand, it's cash at bank, and it's a bank OD, which is supposed to be included, and this is negative. So when you take the figure of cash, you are going to consider cash plus the cash at bank and minus the bank OD. This is just the cash element. Now the other input what comes to the mind is what is a cash equivalent. So let's understand what is a cash equivalent. Something we said is as good as a cash. Well, there is a definition in the standard, but I'll not get into the definition immediately. But I would say when you look at cash equivalents, they would be short-term, highly liquid investments. The term used in the standard is short-term, highly liquid. Generally, your marketable securities, when we use the term marketable securities, they're considered to be short-term as well as highly liquid in nature. So when we're looking at the cash equivalents, we're considering the short-term, highly liquid. The terms are very clear. Number one, it is short term. And number two, we're saying highly liquid investments. Now, the question rises, how would you decide that the investment is something which is both short term as well as highly liquid in nature? Generally, the standard says that the maturity is supposed to be 3 months. If you see that the maturity is 3 months, and I'm going to show you something. So we can say if the maturity is supposed to be 3 months from the date of acquisition, it is 3 months, it says from the date of acquisition. I'm putting it as DOA. So if the maturity is 3 months from the date of acquisition, it is considered to be you can say cash equivalents as good as cash. So I think we've understood the deeper meaning of the word, what is cash. So I would say now, if you tell me that what is included in terms of cash, I would say that there are a total of 4 elements which are included in terms of cash. You add the cash in hand, you add the cash at bank, you add the short-term investments, and you subtract. And you subtract a bank OD, considered that it is repayable on demand. So I think we have done very well understood what a cash is. If you look at the study material, they have also given us a lot of inputs in terms of cash equivalents. And I think we will shortly go to that illustration in a few minutes from now, where they've given us certain examples and we need to understand whether it is a cash equivalent or not. But we'll go to that slightly later. Let's now go on to the next term with you. And the next word on the statement, on the name of the standard, is called flow. Now, when we say flow, it means both inflow as well as an outflow. When I use the word flow, it is indicative of both directions. It would mean that we're looking in terms of inflow and we're also looking in terms of outflow. So this is what the meaning of the word flow is. And then comes the input that when I say cash flow statement, I guess we can understand a statement which will give you the inflow and outflow of cash and a cash equivalence. So we understood it correct that when I'm looking at a cash flow statement, we can say that it is a statement which will give you the inflows and the outflows of cash as well as something which is as good as cash. Now, I want to say something at this stage which may not be technically correct, but I think I want to still give you a larger understanding of the picture. So don't take me, don't say that this is not technically correct. Don't judge me on that statement, but this is just to give you a clarity. So don't tell me, sir, this is not technically correct. I know what I'm trying to tell you is not technically correct. So I am just going to make that statement for a little more clarity of thoughts. We all know that when a company makes its internal records, one of the internal records is called a journal. And in the journal, we prepare what we call a cash book. Of course, if you're thinking that cash book is a ledger, it's not a ledger. You're all aware that as far as a cash book is concerned, it is a journal which summarizes all the transactions in cash and bank. And when you make your financial statements, in terms of the financial statements, one of the components which we make is called a cash flow statement. The question what comes to the mind is, is this cash flow statement and is this cash book something which is similar or is there something different? Well, I would say yes, they can be different, but let's not get into the technicality at this stage. If somebody were to ask me as a layman, just for a better understanding of the concept, I would say your cash flow statement is more or less a replica of the cash book. The only difference is that when you prepare a cash book, it gives you information about the cash inflows and the cash outflow. Even the cash flow statement gives you information about the cash inflows and the cash outflow. But I would say the main distinction is that when you look at a cash flow statement, it tells you the inflow and outflows activity-wise. Because we know, based on your understanding on the accounting standard 3, that when you prepare a cash flow statement, you segregate all the business activities in terms of 3. We say that activities are either operating in nature or they're investing or they're financing in nature. A cash book would not give you segregated information. It just tells you that this is the receipts, that is inflow, and this is the payments, that is outflow, that's it. It does not give you information on a segregated level that this is from the investing, financing, operating activity. So I would say the thin line of distinction would be that this cash flow statement gives you the information that what is the inflow, outflow in terms of operating activities, in terms of what we call investing activities, and in terms of what we call financing activity. As far as the cash book is concerned, it does not give you any such information. I would say that is a basic distinction to understand. So I know what I'm saying is not technically correct. You would say, no, sir, a cash flow statement is something which is made on a cash and a cash equivalent basis. I already made my disclaimer. So let's not get into the technicality, but I would say that, the internal records, a cash book, that becomes a base to make the external records. A company is preparing as a part of its internal records a cash book, and I'm basically producing that as an external document as well in the form of a cash flow statement, telling the stakeholders that this is the inflow outflow, and let's give you the informations on each and every activity level. That's what we can understand from a basic perspective. So let me just quickly consolidate the inputs before we take the journey forward. So I have just given you very basic inputs on the cash flow statement. So we said that as per Ind AS 7, when you look at the word cash flow statement, there are three terms which comes to the mind as we look at the name of the standard. One, as we said, is cash, and we made a list that cash is comprising of a total of four components. You've got a cash in hand, you've got a cash at bank, you've got short-term, highly liquid investments maturing 3 months from the date of acquisition, minus the bank OD, provided it is repayable on demand, and if there is nothing to the contrary, we presume it's repayable on demand. The word flow means inflow as well as outflow, and a statement of cash flows would mean that you're making a statement which will give you the information about the inflows and outflows of cash, and that also segregated on activity-wise basis. Somewhere we can say, for understanding perspective, it's a replica of a cash book, which also gives you the inflows, outflows, but this is going to give you inflow, outflows on a segregated activity-wise information. I think that seems to be pretty understandable, I guess. Okay, I'm getting questions, sir. Are FDs considered as cash equivalents? We are now going to take an illustration with you, which is given in the study material. So we're going to first work upon cash equivalents. Then we're going to work upon the three activities, that what are the activities which are operating, investing, financing. So before we get into the art of making a cash flow statement, we're going to work first of all on two inputs. We're going to work first of all in terms of what are cash equivalents in detail. Then we're going to understand the three activities. Then I'll come to the practical aspect of how to make a cash flow statement. So let's take you to the study material. I have taken certain extracts from the study material. And before we go on further, let's have a look at a very simple sample. A very simple sample of a cash flow statement. This is given in the study material itself, and you can see that it's a very simple sample. I guess this should be pretty visible. I think the font is good to go. So let's have a look at a very simple sample of how a cash flow statement looks like. So a simplified example of a cash flow, you can see there is a cash flow from operating activities. There is a cash flow which is used in investing activity, and there is a cash flow which is used in financing. You can see the word from, you can see the word used as very distinction. When you say it is from, that means the inflows are greater than the outflows. And when you say it is used, it means the outflows are more than the cash inflow. And when you see that there is an outflow, you're going to put it in brackets. And when you see it's an inflow, it is without brackets. So this is the net inflow, and this is the net cash outflow. So we use the word from when the inflows are more, and we use the word used when the outflows are more. So the information on the cash flow statement is telling you that this is the net inflow outflow from various activities. And then you get what is the net cash which is generated during the year. So this is net cash generated because it is a positive figure. The sum total of all these three is net positive. So it tells you this is the net cash which you have generated from your during the year. And then we consider the cash and cash equivalents, which is at the beginning of the year. And this will tie up with the cash and cash equivalents, which is at the end of the year. So if you look at the balance sheet of the company, if you look at the balance sheet of the company at the beginning of the year, it's going to give you the information of the four elements of cash and cash equivalents. And if you look at the balance sheet at the end of the year, you're going to get the cash equivalents at the end of the year. And trust me, what are we trying to explain in a cash flow statement is the movement of the cash equivalents during the year. And that's why it very clearly says during the year. So this is the equivalence in the balance sheet opening. This is the equivalence, cash equivalence in the balance sheet closing, and we elaborate the movement. So one thing is very clear, that when you make a cash flow statement, you know your answer well in advance. Because to make a cash flow statement, I would need the balance sheet undoubtedly. and I would need an income statement if I'm using an indirect method. So with the help of that, you will know well in advance what are you trying to capture. So looking at the balance sheet, you know the opening, closing, and you know that what is the difference. The difference is the sum total of the operating, investing, financing. So this is very simple, just a presentation of a cash flow statement, how it looks like. So this is also, helping me to develop certain steps, which I will document later. But I'm going to give you some steps with the help of which you can clearly identify that, how do we make a cash flow statement? Now, I would say the very first step I'm going to do in every question on a cash flow statement is look at a balance sheet and get my opening and closing cash equivalents, so that I know well in advance that this is the answer which I need to achieve. So every time you begin a question, rather, I would say every time you begin a question, before you apply the steps, your first focus should be to look at the dates in the balance sheet. Because many people falter in terms of making ledger, because when you're given a balance sheet first for the latest year, that is the current year, and then for the previous year, and when you're making ledgers, your previous balance is balance BD and your current year is supposed to be balance CD. Sometimes if the examiner gives you the balance sheet in a reverse order, your BD CD could be, jeopardized. So I would say when you start with a question, your very first focus should be, before the application of the steps, watch out what are the dates of the balance sheet. Don't worry, we'll document that also very soon. Then I would say that you can start with your step number one. And in terms of step number one, go to the balance sheet of the company, identify the four elements of cash equivalents at the beginning and at the end, and just make a statement. That's it. So could there be any other challenges in terms of step one? Yes, but we're not talking of those challenges as of now. So step number one as of now is just add the four elements. That's it. But there could be challenges. So we know what is the challenge. There could be a foreign exchange gain or loss arising on account of a short-term investment. If it is in a foreign currency, you're already smart people. Let's take the journey forward now. So this was a basic sample. Now I want to take you to a little more inputs on the concept of cash equivalents with you. So we're going to look at the concept of cash equivalents because there is an illustration and we want to get a little more expertise in terms of identifying the cash equivalents. So where do people falter? I'll show you that. Now, when you look at a cash equivalence, I think I am wanting to take you out here to few clarifications. And first, let's look at this. For an investment to qualify as a cash equivalent, it must be readily convertible to a known amount of cash and is subject to insignificant risk of changes in value. Therefore, investment normally qualifies as a cash equivalent when it has got a short maturity, say 3 months or less from the date of acquisition. We are not saying from the date of the balance sheet. We are saying from the date of acquisition. And that's what, sometimes we falter. We say 3 months maturity. So which means the period of 3 months, the period of 90 days is going to be counted from the date of acquisition, not from the date of the balance sheet. Okay, this is one input. I've already, put that across date of acquisition. Some clarifications are given that if you've got equity investments, they are excluded unless you can prove them that they are in substance cash equivalents. So generally, when you go to consider the investments, the terminologies could be that they are marketable securities. The terminology could be that they are something which is going to mature within a period of 3 months from the date of acquisition. Okay, so I think let's consider it further. There is an illustration number one. So let's have a look at the illustration one. Good to go. I guess the visibility should be good, I believe. So let's have a look at the cash equivalents. So we're given some informations. We need to decide, as one of the, I think, friends asked me, so is a AFD supposed to be a cash equivalence? You're going to get all the answers in this illustration. The company is provided the following information regarding the various assets held by the company on 31st March X1. That is supposed to be the balance sheet date. Then he says find out which items will be a part of the cash and cash equivalents and for the purpose of making cash flow statement as per Ind AS 7. Now, the first thing you can see that I am given a fixed deposit with SBI, and it says there is a 3 years maturity on 1st January X4. We're sitting on X1, and that means we've acquired it this year, but it is not going to mature within a period of 90 days. So this in any case cannot be considered as a cash equivalence. It is not short term. It is undoubtedly long term in nature. Then we're given that there is a fixed deposit, and in this particular case it says original term was 2 years. The original term was 2 years, but it is due to mature on 30th June X1. It is going to mature within 3 months from the balance sheet date, but it's not going to be maturing within 3 months from the acquisition date. Did you get my point? It is going to mature 3 months from the balance sheet date, but you need to consider 3 months from the date of acquisition. I know your mind is now going to run wild. Sir, if I acquire a long-term investment which is about to mature in 90 days, would that be a part of the cash equivalents or not? Very shortly, we'll see that example as well. So in this case, since the original term is 2 years, it is not going to mature within 90 days from the date of acquisition. So this will also be excluded as original maturity, as the original maturity is not less than 90 days. So I think my friend would have got his answer that when you're looking at fixed deposits, if the company makes a fixed deposit which is got originally a maturity more than 90 days, it is not a part of the cash equivalence in this case, right? Not clearly visible. Please tell me, is this clearly visible to everybody? Because sometimes your internet could also be a problem. Do tell me, friends, is the visibility okay? Is the font good to watch? Because I just got one input, it's not clear, but I think I put it, zoomed it quite good. It is visible, clearly visible. I think your internet might be giving you a challenge. Please just refresh it. Increase the size further, then the question will not get fit in. Okay, we'll see if we can just slightly cut it further. Okay, then I think let's do it like this. I think this should be good enough. More than this is going to be dangerous, I guess. Okay, so this is done. Then I'll have to perhaps now remove this, clear this out as well, because alignment changes. Okay, I think this should be good enough, I guess. Okay, so let me just clear this part as well, and let's take it further. So I think we were very clear on the concept of the fixed deposit, that this is going to mature 1st January X4, and this FD is got an original term of 2 years. So both are not to be taken as a part of the cash equivalence. Now comes a very interesting input as well, and this will clarify the entire concepts to you. It says there is a redeemable preference shares which is acquired on 31st January X1. The date of acquisition is 31st January X1. The balance sheet date is 31st March X1. And the redemption is on 30th April. So which means if you acquired it on 31st January, that means February, March, April, 3 months. Now, since this preference share was acquired and its maturity is 3 months from the date of acquisition, it would be a part of the cash equivalence. So it is included as is due within 90 days from the date of acquisition. So moral of the story, If you are making an investment with the original maturity period more than 90 days, is it a part of cash equivalence? No. If you acquire an investment which is got a maturity within 90 days from the date of acquisition, is it going to be considered as cash equivalence? Yes. So where does the counting begin? The counting begins from the date of acquisition, not from the date of balance sheet. Many people have got the confusion that a cash equivalence in life is something which is going to mature within 90 days from the date of balance sheet. No, no, no. It is going to be 90 days from the date of acquisition. You can clearly see that this is maturing within 90 days from balance sheet date, but since the original period is supposed to be more than 90 days, it's not equivalent. But in this case, you acquired it and it's going to mature within 90 days from the date of acquisition. So therefore, it definitely becomes a cash equivalence, right? I hope you got your answers on that. Then he says cash balances at various banks. It doesn't make a difference whether the money is in India. And then it says cash balances. It is all international branches. It doesn't make a difference. That is all sentimental information. If you got cash, whether it is an inland branch or in a foreign branch, doesn't make a difference. It's all going to be included in this case. The cash balances, and this is in the foreign banks outside India, doesn't make a difference. We're going to consider this all as a part of the cash. Then he says it's a bank OD and it says it is temporary overdraft, which is payable on demand. And I've already said that if you got a bank OD which is payable on demand, that is definitely considered to be a negative cash equivalence in this case. So it would be included. And then it says treasury bills which has got a 90 days maturity. So that would of course be included. I think now we should be very clear that what is a cash and a cash equivalence. So I think I can undoubtedly just recall that we are going to consider cash in hand. We are going to consider cash at bank. Don't give me sentimental, emotional reasons. It's in India, outside India, inland branch, foreign branch. Yes, 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 yes. And then we're looking at all those short-term investments which are going to mature 90 days from date of acquisition, not 90 days from the balance sheet date, right? So this is on the cash equivalence concept. Okay, let's take the journey forward. Having understood this particular part, I think let's now take this further. And I am now coming to the second area of discussion. So we've understood the concept of cash equivalence flow. We already know inflow, outflow, but now the focus is on the types of activity. As we said that when a company is going to make a cash flow statement, we are not still working in terms of the methods. How do you make a cash flow statement? That is a next agenda of discussions. Right now, we're focusing on the terminology which we need to know. So when a company is going to make a cash flow statement, in this particular case, all the activities in the business are segregated into three. This you know even otherwise from your interlevel. So all the activities of the business are segregated into three. One is called operating activities. One is called investing activities. And one is called financing activities. And in the study material, there are three illustrations devoted in terms of getting a very good understanding of what is operating, what is investing and financing. But let's first understand this conceptually, then we'll go through those illustrations as well and understand the art of identifying them. Now, I know sometimes people do falter in terms of identifying the nature of the activity. So let's make your life simple. Let's give you some basic understanding. Rather than talking of operating activities, let's first start a discussions in terms of financing activity because that's easy to identify. I would say if you're looking in terms of financing activity, anything which relates to, I would say debt equity financing. Anything which relates to, I would say debt equity financing is going to be financing activity in nature. A company raises money through equity shares, goes for a buyback, raises money through bank loans, debentures, or repays the bank loans or debentures, preference shares, they're all supposed to be financing in nature. I would say anything which is indirectly, I would use a little better term. I would say anything which is related to the capital structure of the company. Anything which is related to the capital structure of the company, that is what I would say is financing in nature. When you look at a capital structure, the focus is always on debt equity financing. So indirectly, when I say debt equity financing, the focus is, of course, on the capital structure. So if the company is looking at what is financing, anything related to debt equity financing. And let me also tell you something which we'll see later in examples as well. If you're raising money through debt equity financing, any kind of interest paid on the debt, any kind of dividends paid on the equity is also going to be financing. I am not looking at companies which are financial institutions. There could be a different presentation if you are a financial institution. We're looking at a generic, a general kind of industry, not something specific, which is a bank or a financial institution. A normal company other than a bank's financial institutions, for them, the interest paid on the debt is financing. The dividends paid on equity is also financing. So if I'm going to consider that there is any dividend paid, that would be financing. If there is any interest paid, that would also be financing. But this is not applicable to the bank or any kind of financial institution. So I think that makes it very simple that anything linked to the capital structure, anything which is supposed to be debt equity finance linked is all financing in nature. Now let's go on to what is investing in nature. Mind the words carefully. When I'm looking in terms of investing, I would say typically movements related to tangible, intangible, non-current assets. Mind the words what I said. I did not say assets, I said non-current assets. So if you see any kind of movements, if you see any kind of movements with regard to tangible or with regard to intangible, I said non-current assets. I did not say current assets. The focus is, I said it is current assets. And how does company raises financing from a buyback? Well, buyback of equity share is like an outflow in terms of financing activity. Now, we're not going to go into how the company organizes funds. The objective is to see which activities will fall under which category that is there. We're not looking at how do you organize that funds. That would be finance. So we're looking at tangible or intangible non-current assets and any movement as far as investments are concerned. Of course, we're not looking at short term. We're not looking at the cash equivalents. So if there is any kind of movement which relates to non-current assets, tangible, intangible, there is a purchase of PPE, there is a sale of PPE, there is a purchase of patents, there is a purchase of goodwill. If you buy somebody's business and the consideration is given in cash, then even that purchase of goodwill is intangible in nature. Buying of patents, buying of copyrights, they're all tangible, intangible movements. Investments, it could be in terms of related parties, it could be in terms of unrelated parties. Don't get sentimental. Investment in a subsidiary, yes. Investment which is as a passive investor, yes. All these movements will get captured in the investing activities as well. Which also brings me to another $1,000,000 question. So which means that if you make an investment and you get a return on those investments, that means you get some interest or you get some dividends, even they will become investing activity. Here again, I'm not referring to banks or financial institutions again. So if there is any dividend received or if there is any kind of interest received, these are all returns on the investments. So they would also be considered as investing in nature. So I think that makes my life simple. What is financing linked to debt equity? What is investing? Tangible, intangible, non-current assets and investment. So basically, if you ask me, what is operating? I would say balancing figure. I would say balancing figure. What is not operating, what is not financing is operating. But as the word goes, operating, it means something which is coming from business operations. So you are going to consider something which is related to the business operations of the company. Something which is related to the business operations of the company. And many people have got questions like, sir, the income tax which I pay, well, I would say depends. But if you're paying a tax on your business income, it is certainly operating in nature. But let's say, for example, there is a sale of investments and you're paying some capital gain tax on the sale of investment, then that's going to be considered as investing activity outflow. But if you're going to pay some income taxes on your business income, undoubtedly it will be considered operation, because the money, the profits which you generate from the business operation, and that is supposed to be, operating. So per se, I'm saying per se, if you look at the concept of income tax, I would say the income tax paid on the business income undoubtedly is considered as operating in nature. I guess we get a basic flavor in this case. And investment, either current, non-current, well, if it is not a cash equivalent, then it is in the investing activity. If it is not a cash equivalence, then I'm going to put it out here in this particular case, because this investment is excluding those cash equivalence investments which you've taken in the list. So we are now standing at a very logical level, and we're ready to go and look at some illustrations on the three kind of activities as well. You don't need to put so much pressures in your mind. The examples will make things even more clear as we got the understanding on the cash equivalent. But just keep the basic structure in mind, that anything which is capital structure linked is financing. Anything which is tangible, intangible, non-current assets and investments is investing. Business operations is operating. The salaries I pay to the employee, operating. The debt collection from the customer, operating. The payment to the creditors, operating. Depreciation, no, non-cash in nature. Also remember one thing, as we discuss the concept of a cash flow statement, if you see any item which is non-cash item in nature, something like depreciation, for example, they do not appear in the cash flow statement. They're not captured in the cash flow statement. Because as we are making a cash flow statement, is going to reflect the movements of inflows and outflow, any kind of non-cash movements. So if suddenly out of the blue, I tell you credit sale, it doesn't appear in the cash flow statement. I will show a debtor's collection, not a credit sale. I will show the payment to creditors, not a credit purchase. So we're not going to capture any kind of non-cash item movements in the cash flow statement. We need to capture items which are involving cash. I think we're ready in terms of looking at three more illustrations on this. Then I think you can focus in terms of the methods as well. So let's begin the journey. I am carrying those extract of the illustrations as well. Let me know if the font size is good to go. I want to show you the illustration in a single go itself. I need to show you the first one as well. Is it good to go? Can we see this? Visibility fine? Okay, I get a yes on that. That's great. So let's begin. Let's begin the journey. At least let me first read the initial part, then I'll zoom it a little further. This is illustration number 2 in the study mat. From the illustrations, we need to consider the company is in the business of trading mobile phones. So please keep this in mind, that the company is in the business of mobile phones. Let me zoom it a bit further now. I think that should be good to go. So now as I read the illustration, you also try to visualize, is it operating or not? So let me just clear this bit. Okay, so first we are given, or maybe we can do something, I guess, zoom it out here, but then you'll start looking at the answers. Okay, that's okay. It says receipt from the sale of mobile phones. I'm in the business operations of selling mobile. definitely operating in nature. There is a purchase of mobile phones from various company. That's your business operations. It is definitely operating in nature. Employees are paid the salaries. That is definitely operating in nature. You incurred some advertisement expense. You paid the advertisement money. It is again relating to business operation. Then it says there is a credit sales of mobile phone, and I think I very clearly said your cash flow statement will capture the collection from the debtor, not the credit sale. So this is not to be shown in the cash flow statement. Miscellaneous charges received from the customer for repairs of the mobile. I think this is something which is incidental to the main business, and if it is incidental, it is certainly operations in nature. Then he says loss due to decrease in the market value of the closing stock. Closing stock is something which is unsold on the balance sheet date, and if there is a loss due to decline in market price, it's an unrealized loss. And if it is an unrealized loss, it's not a cash movement. And if it is not a cash movement, then it's not taken in the cash flow statement either. Okay, that was pretty easy. So few more examples. Let's have a look at few more examples as well. So then I am given further inputs. It says the payments which is given to suppliers, that's payment to creditors, certainly it is operating in nature. Depreciation, we've just seen a little while back, it's a non-cash item. It cannot be reflected in the cash flow statement. The interest paid is not supposed to be operating, but it is supposed to be a financing activity. And then it says the profit on sale of old computers in exchange of the new laptop. If you're going to exchange the items, there is no movement in terms of cash. And if there is no movement in terms of cash, we are not going to reflect it as a part of the cash flow statement. So non-cash movement. Then he says advance received from the customer, that again is business operations. The sales tax and the excise duty paid, which is again a business operation. It is all operating in nature. I think this illustration makes it very clear that when you're looking at the business operations, we're looking at all the main activities and incidental thereto. Like in this case, we saw that the sale and purchase of the mobile phone and even the repairs, the money which you're making is all operating in nature. That was on the operating activity. Let's take more illustrations with you and let's have a look out here. So I think maybe we can directly take you to the sheet out here. Yes. So we can directly, because the answers are given, that's okay. But I guess we can directly run the answers directly, the questions and the answers directly out here. Okay, so point 8 says payment to supplier, then purchase a mobile shown earlier is not a credit purchase. I can understand, you're going to do 2 plus 2, 4. That's okay. You see, when it said a purchase, we are assuming that could be a cash purchase. Why do you want to call it as a credit purchase? A business can have a cash purchase and a credit purchase. So don't suspect them too much. Okay, so I think that's good to go. Somebody said zoom more, please. I think that's good to go. We can zoom it further as well. That's okay. So I think that should be good enough now to see. Okay, so let's look at now. It says the interest which, okay, now first I need to give you some inputs as well, at least the background of the question. The following transactions are taken from a private sector bank operating in India. Now, in this particular case, we're looking at a banking industry. So let's do one thing. Let's give you a clarification chart with regard to the interest and dividend for a financial and a non-financial institution so that there is no problem at all. So let's do one thing. Let's create a simple chart below. You can take this, note it down as well. So I'm just going to give you a simple clarification that if you're looking at a financial institution or you're looking at a non-financial institution, I want to get a clarity with regard to the interest which is paid and received. And I also want to get a clarification with regard to the dividend paid and received, because I think this is something which can disturb you later. So let's pen it down and let's have a look in terms of what is treated how. So let's first consider a non-financial institution. If there is an interest paid, it is operating activity. If there is an interest received, it is investing, as I've already mentioned. If there is a dividend paid, it is financing. And if it is, sorry, interest paid, my bad, it is supposed to be financing in nature. And as far as the dividend received is concerned, it is investing in nature. So that we've already just made a mention. Any interest received, dividend received is investing. Any interest dividend paid is financing. This is for a non-financial institution. Now let's have a look in terms of financial institution. Interest paid, operating. Interest received, operating. Dividend paid is financing. Dividend received is operating. It is the business operations of the bank that they are going to give loans to the customer, so they're going to get interest income. It's basically that they are going to get deposits from the customer, pay them interest. So any interest paid and received on the loans and advances is operating for a bank. But they will also have their own capital structure. So the dividend paid is financing in nature, and the dividend received is again going to be operating. So the illustration number 3, which you're watching now, is based on a bank. So when you answer the interest and the dividend, please consider that you're looking at a bank operating in India. Okay, let's, I think, now take it further. So the answers, especially with reference to interest and dividend, the focus is on the financial institution, not a normal non-financial concern. So it says there is an interest which is received on the loan for a bank, it is operating. There is an interest which is paid on the deposit for a bank, it is operating, because that's the business operation. You accept deposits for a bank, it is operating. The loans are given to the customers for a bank, it is operating. The loans are repaid by the customer for bank, it is all operating. The deposits are repaid for the bank, it is operating. Oh my God, that's simple. Then it says the commission received for the bank getting a commission is operating. The lease rental paid for the various branches, you are paying the rental, and this is to carry on your business premises. So that is again operating in nature. The service tax paid is again for the business operation, so operating. But if you buy a furniture, undoubtedly investing. You buy a software which is intangible in nature, undoubtedly investing. You buy a shares in 100% subsidiary, related, unrelated, undoubtedly it is investing in nature. Okay, so why dividend received is operating in nature for a bank? They might be handling portfolios, and if they're handling all those portfolios, it is basically a business operations for them, because banks would be doing this as a part of their business activity. So except for the dividend paid, you can say everything is going to be considered operating, because their job is handling those kind of portfolios, right? Okay, so there are more examples, I guess 3-4 more examples on this illustration. So let's have a look, I think, on the 13, 14, 15, then I can zoom it further, or let's put it like this. Okay, let's put it like this. So another few questions continued with the illustration number 3. Okay, I'm getting a question. So why dividend received is an operating for a bank? I just answered that. Banks are the business of lending loans, etc., not investing in companies. Okay, as I just answered, that banks would also be handling investment portfolios as a part of the business operation. So dividends received is going to be considered operating, because it's a part of the business operations. Okay. Then he says new cars are purchased from a dealer in exchange and a cash payment as well. So there are two elements of the transaction. There is an exchange does not appear in the cash flow statement, but there is a cash payment that would appear. So only the cash component payment which is paid is investing in nature. The provident fund which is paid for the employees is operating. That's a part of the business operations. You issue ESOPs. Well, when you issue ESOPs, in that particular case, there is no cash movement. And if there is no cash movement, it does not get reflected in the cash flow statement itself. Okay, so I think that should make our life simple. I think the examples given in illustration 2 and 3 would appropriately give you a lot of food for thought in terms of deciding the nature of activity. Let's take another illustration in terms of financing as well. Let's go to illustration number 4. So we're now on illustration number 4. So let me just zoom the answers itself. I think this is good to go, I guess. Okay, somebody has got a question. So can a transaction be both as well? Yes. Yes. A single transaction can also include two activities as well. For example, you pay a hire purchase installment, which is like making a lease payment. Now, when you're going to make a lease payment, there will be two components which are there in terms of the lease payment. One is the principal component, which is going to be considered as investing, and the other is the interest element, which is going to be considered as financing. That's a good question. So which means it is not necessary. We can't say that every transaction is going to fall in a single activity. A single transaction could fall into multi-activity. As I said, this example is there in the standard as well. It was there in accounting standard 3 as well. That if a company makes a payment of a lease payment, or let's call it as a hire purchase installment, you've got a principal component and you've got an interest element. The interest becomes financing and the principal becomes investing in nature. Okay, then let's have a look further in terms of the illustration number 4. Now, this is a normal company. Don't think it's a banking or a financial institution, normal concern. So it says we issued preference shares, capital structure linked, it is financing. We purchased the shares of a subsidiary company, that is investment in related party. You received a dividend, so that is again investing. The dividend is received from other companies. It's just going to make you emotional. You get it from a related party, you get it from an unrelated party. It doesn't make a difference. It is undoubtedly investing. Bonus issue which is made. Now, when you're going to make a bonus issue, it is made out of the retained earnings of the company. So the company has got no cash movements. It's not going to be captured in the cash flow statement. So no cash flow. Purchase licenses for manufacture of drugs, that is investing. Intangible in nature. Non-current assets, intangible, as I said. You receive a royalty from the purchase of goods patented. Receipt of royalty is operating. The rent is received. This is not our main operations. You are earning a rent out of a property which we technically call in Ind AS as investment property. Now, it's not my business operation, then it is investing. You invest in the property, it is investing. You get a rent from that property, it is again investing in nature. The interest received, of course, investing. Loans and advances would not change the answer. Dividends are paid, financing in nature. Interest which is paid, it doesn't make a difference on the security deposit, it remains financing. They've given you a lot of examples to make it clear. Interest paid is financing. You say loans and advances, financing. Security deposit, financing. Debentures, financing. It doesn't make a difference. We purchase a goodwill considering that you paid the consideration in cash, that is investing in nature. Acquired the assets of a company by issue of equity shares. If you acquire a business and the consideration is paid in cash, it gets reflected in the cash flow statement. You acquire a business and the consideration is paid in the form of equity shares. There is no cash movement. It does not appear in the cash flow statement. Then there is interim dividends paid, that is financing. Dividend is final, dividend is interim, it is financing. You dissolve the subsidiary, that means you sold the investment, it is again investing in nature. I think with these three illustrations, and rather with say four illustrations, one is on a cash equivalence, one is on operating, one is investing financing. I think we're done enough of a PhD in terms of understanding the nature of activities. Now, don't let your mind run further wild. We need to focus now in terms of how to make a cash flow statement as well. I hope everybody is wonderfully clear in terms of things. So there is a non-refundable security deposit can be investing in nature. Well, it does not make a difference okay, let's give you something. As I said, don't let your mind run so wild in nature. You see, you need to understand one very important thing. Let me make it clear. I think let me push it a little further so that you get it very clear. Hear this very carefully. You need to be fundamentally very clear on the position. I always tell people, and I'm going to tell you today this as well, let's have a look at this input. Just watch this carefully for a better conceptual clarity of things. You make your income statement. This is one component. And you make your cash flow statement, that is another component. So there is an income statement and there is a cash flow statement. Get one thing very clear. Why does a company prepare an income statement and a cash flow statement? Let's not talk of a balance sheet. A balance sheet, of course, is a document which is depicting the assets and liability, and it is presented as on a particular date. But when you look at a cash flow statement or an income statement, this is a document which is prepared for the year ended. It gives you an information for the year ended. So what is the basic objective of income statement and a cash flow statement? Now, I'm just going to make some statements. Don't judge me on that. And don't tell me, sir, no, this is technically wrong. I know some people have got a very interesting character of evaluating. Sir, you said this word, like somebody said at the beginning, sir, you said it's not cash flow statement, the statement of cash flows. Don't cram concepts like that. Go with logics. Now, don't judge me on the statement, but just to give you a clarity of thoughts. When you make your income statement, we all know this very well, that it is prepared on accrual basis of accounting. And when you prepare a cash flow statement, it is prepared on a cash basis. Now, somebody would suddenly say, no, it is not prepared on a cash basis. I know that. I know it is prepared on a cash and cash equivalents, but let's look at the larger picture to understand this. So first, let's understand one thing, that what does this accrual, making a statement would not help. Let's analyze when you say that it is prepared on an accrual or it is prepared on a cash basis. What does this technically imply? Now, when you prepare this on an accrual basis, it means, number one, you are capturing only those incomes and expense which are revenue in nature. That's focus one. You are capturing only those movements which are revenue in nature. That's one. And you are capturing only what is for the current year. And you're capturing something which is for the current year. This is the income which is earned. This is the expense which is incurred for the current year, which you capture on an accrual basis. So you capture items which are revenue and you capture them on accrual basis, irrespective they're received or not. Now look at when you prepare on a cash basis. When you prepare it on a cash basis, then you are capturing both the inputs, whether it is capital or whether it is revenue in nature. You are capturing both the movements. Like, for example, if you purchase a building, it doesn't appear in the income statement because it is not revenue in nature. But when you're buying let's say a building, it's a capital nature. You capture it as a part of the cash flow statement. So every movement, irrespective whether it's a capital item or it's a revenue in nature, gets captured. And you will capture any movement in the current year. which may relate to the previous year, it may relate to the current year, or it may relate to the future year. That's another thing which we need to keep in mind. When you're preparing a cash flow statement on a cash basis, you are trying to capture every cash movement in the current year. This is capturing only what is for the current year, mind you, and this is capturing everything which is in the current year. I hope you get the stress of words. So a cash flow statement is capturing every kind of movements which is supposed to be in things. Now, let me tell you one thing. Anytime you get a trouble in terms of whether it appears in a cash flow statement or not, go back to your basics. Go back to the question of making a cash book, which was a journal. Ask yourself a question. Was this appearing in the cash book? If your answer is yes, it'll undoubtedly appear in a cash flow statement as well. You ask me, sir, I sold a newspaper, I got money. Is this going to be a part of my cash flow statement? Yes, it's a miscellaneous money and it's going to be taken as operating in nature. So any movements which are there in the current year, irrespective of the year it relates to. You're collecting some money, which is a bad debt recovery. I'm going to put it out here in the cash flow statement because we're capturing anything which is in the current year, whether that movement pertains to current, past, or future, whatever. That is one area. Second area of distinction which you need to be very clear is the focus in terms of the income statement is what? The focus in income statement is making a profitability statement. Your focus is to get the profitability of the concern. But this profitability is supposed to be the book profitability, that as per the books of accounts, what is the profitability of the concern? And when you're looking at a cash flow statement, the perspective, the objective is what? Liquidity. So here you are trying to look at the liquidity analysis of the company. So there is a major line of distinction, the underlying thought processes in terms of the two documents. The cash flow statement is got the underlying objective in terms of depicting what has been the liquidity position of the company for the year, so that you can understand. And it's a little early to say that, but I think I'll still say that when you're looking at a cash flow statement, if you remember when we saw that simplified cash flow statement, it started with that there is a cash flow which is coming from operating, because generally I should get a liquidity out of my business operation. Then you could see that there is a money used in terms of investing. I should generate money from operating. So generally for a healthy company, I'm saying generally for a healthy company, you should definitely get cash flows, which is positive in terms of operating and it's negative in terms of investing, because the money which you are taking from your operations is being channelized in terms of investments, and it could be channelized in terms of financing. Well, as far as financing is concerned, I can't say a positive is good or a negative is bad or whatever. But I think operating should be positive. I think the investing should be negative in a very idealistic situation. And I would say financing could be positive or negative, because if you're raising money for expansions, it could be a net inflow. You're trying to repay your debts because you got surplus money, it is an outflow. So that could be good in both the circumstances. So the perception is profitability analysis. The perception is a liquidity analysis. I hope that answers your question, clarifies the inputs as well. So anytime you get a question that is this going to be captured in the cash flow statement, go back to the journal, go back to the cash book and take your call. Is it appearing in the cash book? Yes, it is appearing in the cash flow statement as well. Right, I guess I am clear with the picture. Let me see for the questions coming on the other chat as well. Okay, that's great. Okay, so far so good. So we have done the basics. Oh my God. Sir, almost around 1 hour, 15 minutes, we've just done basics. Yes. Our focus has been in terms of understanding the cash equivalence concept. Our focus has been understanding the types of activities, getting different examples. Now comes how to make a cash flow statement. So that's the next agenda of discussion, how to make a cash flow statement. So let's begin the journey in terms of how do we make a cash flow statement at this stage. Yes, Claire, that's wonderful indeed. Now we are all aware that there are two methods in terms of making cash flow statement. But I sometimes, see that people just cram it and they just know that this is how the method is applied. I think today I'm also going to make a little effort giving you a little more larger understanding of what is exactly a direct indirect method. And I'm going to give you some steps in order to make the cash flow statement as well. So let's, I think, first begin a discussion on the methods which are used in terms of making a cash flow statement. So just like Accounting Standard 3, even Ind AS 7 has prescribed two methods for making a cash flow statement. One is called a direct method. One is called a direct method and one is called an indirect method. So we will be very clearly stated in the exam which method do we need to follow. We'll also give you a call when can a direct or indirect method be applied. But of course, practically, if you look at the financial statements of the company, practically the cash flow statement is always made with an indirect method. Now let's first understand one thing, that when you prepare a cash flow statement using a direct indirect method, the difference is only for presenting operating activity. The investing and financing activity presentation in both the methods is the same. So keep one thing very clear in mind, that when you're looking in terms of direct indirect method, the difference is in terms of operating activities. They are presented differently. But when it comes to investing activity and financing activities, they are presented absolutely in a similar manner. There is no difference in terms of presenting the investing and the financing components of the cash flow statement. The difference is only on the operating front. So let's do one thing. Let's first understand the larger picture. What is this direct and what is this indirect method? So I will first take a very simple example and give you the approach in terms of what is direct indirect. Let's take a simple example to understand the larger picture. Let's give you an income statement. Let's say the sales of the company is 1,000 and let's say the cost of sale, which is equal to the purchases, assuming no opening closing stock, is, let's say, to the extent of 600. So we get a book profit which is to the extent of 400. Now watch this example carefully. You'll get the insights in terms of things. A simple income statement I've given you. Let's also give you a little more information regarding the opening and closing position of debtors in the company and the opening closing position of creditors in the company. So I'm also looking at the opening debtors and the creditors. So let's consider the opening debtors is to the extent of 400 and the closing is 600. And let's say the opening creditors is 100 and the closing creditors is 150. That's it. I'm assuming that all the sales are on credit. I'm assuming all the purchases are on credit. That's my assumption. I'm taking a very simple base example to illustrate the direct indirect method. So all the sales and all the purchases are on a credit basis and the position of debtors and the creditors is defined. Now, let's first of all do this cash flow statement with a direct method and then we'll see the indirect method. So we're going to do it twice. We're going to see this from a direct and indirect method perspective. So let's first have a look at a direct method and then we'll see the indirect and we'll understand why it is called an indirect method as well. Now, in a direct method, what I need to do, I need to basically tell the stakeholders directly. I need to tell the stakeholders directly, this is the inflow and this is the outflow. I'm going to give inputs directly. So how do I give the inputs directly? My opening debtors were 400. I made a further credit sale of 1,000. That makes it 1,400. Minus 600, that makes it 800. I'm getting my debtors collection. Alternatively, you can make a debtors account and you can get your debtors as well. So in this case, the opening is 400, the credit sale is 1,000, makes it 1,400 minus 600, we can say the collection from the debtor. The collection from the debtor is supposed to be 800. That becomes an inflow, direct in nature. Similarly, we can also get the payment which is made to the creditors in this case. My opening creditors is 100 and the purchase is 600. Mix it 700. 700 minus 150. We can say the payment to the creditors is 550, which is an outflow. So what you've done, you've translated the information and you're saying, let me tell you directly, this is inflow. Let me tell you directly, this is outflow. So what is my net inflow? My net inflow is to the extent of 250. I think everybody would appreciate and understand that this is the direct method, telling the stakeholders directly. Now, let's have a look in terms of the indirect method. In an indirect method, what we do, we consider the book profit. I'll call it as a book profit as a base. The idea is to convert this book earnings into a cash earnings and get the inflow indirectly. So why do we call it as an indirect method? Because the idea is to convert the book earnings into a cash earnings. Though there is much a larger picture which awaits you, we'll see that larger picture later as I give you the steps. But when you're considering the book profit, I'll give you a little more intensified inputs as far as the conversion of book profit to cash profit is concerned, because that's where people falter. And I'm going to make you experts on that area. T&C apply. So the idea is to convert a book earnings into cash earnings. So what I'm going to do, I'm just going to consider the increase or decrease in terms of the current assets and the current liability, because I've not given any other information. So what do? You take the changes in the current assets and current liability. Now, your debtors have increased by 200. So if there is an increase in the debtors by 200, the question arises, is it increasing my liquidity or is it decreasing my liquidity? Your debtors are increasing, so you're not able to collect. If you're not able to collect, it is decreasing your liquidity. So what we'll do, subtract. So that's what we do. All the increase in the current assets is reduced, because that means you're blocking funds, your liquidity is getting compromised. Similarly, if you look at, there is an increase in terms of creditors and the creditors is increasing by 50. Increase in creditors means that you are getting more credit from your suppliers, which is indirectly increasing your liquidity. And if it is increasing, let that be plus. And if you work out the answer, that comes to 250. And you can see that both these are matching. This is, of course, got to be GDP. So what you've done in this case, you've indirectly translated the book earnings into a cash earnings. You've indirectly translated the book earnings into cash earnings. And I want to show you with this simple example, more insights in terms of how did this exactly happen. If you notice what was the book profit, it was a sales minus the cost of sale, that is 600. Now watch the mathematics, very simple. Can I say this is 1000? And minus 200. If you take 1000 minus 200, what is it? It comes to 800. So what have you done? You are indirectly translating this into a cash earning. A direct method tells you directly. An indirect method tells you indirectly. Similarly, you can see that this is minus 600 and plus 50. So minus 600 and plus 50 is minus 50, 550. So what you've done, you've converted your book earnings into a cash earnings, and that is called indirect method. So the presentation difference is only in terms of, you can say, operating. As I said, the investing financing is similar. So when a company is going to use a direct method, it needs to present data directly. When it presents indirect method, it will convert the book earnings into cash earnings. Now, before I give you these steps, I think I want to make one thing very clear, because I have seen many times that, students falter in terms of converting this book earnings into a cash earnings. You want me to make your life simple and tell you something with which you can easily make cash flow without any mistakes? Yes, sir. Give me a thumbs up on that. Do you want me to make your life simple on that? And I want give you a technique with which you can easily, in a very relaxed mode, make a cash flow statement without doing any falter. You want me to do that? Great. So what I'm going to do, I know as I'm going to tell you things, you'll tell me, sir, logic. Why did you do this? Why did you do that? You'll get the logics also, no worries on that. But first, I think let's come on to the inputs of converting a book profit into cash earning is an art. Let's learn that art. Let's learn the art of converting this. So before we come to the steps, let's come back to indirect method only. And let's first of all analyze and understand one thing. Go very systematic because I'm going to give you steps after this. How do we make a cash flow statement? We'll do a larger question with you as well, which will give you a good idea in terms of how to apply those steps as well. Now, in an indirect method, the idea is that you need to convert a book profit. You need to convert a book profit in terms of what we call a cash profit. So converting this book profit into a cash profit is something which is going to be done in 2 stages. Mind it carefully. Please mind each and every word, because this is where people falter. And if you're able to get a grip, then life is simple. So converting this book profits into a cash profit is going to be a 2 simple exercise. It's going to be a 2-step exercise. In step number 1, let me first tell you that when you take the book profit as a base, please start with PBT. This is going to be your starting point. Don't take PAT. Your starting point in this case is going to be a PBT, a profit before tax. So when you're going to start with this, you're going to start with a profit before tax. We start with net profit before taxation. Now, the step number 1, what you need to do is you need to watch out for any non-operating. You need to watch out for any non-operating items. I did not say expense. I did not say incomes. I very clearly said that you need to capture non-operating item. Sir, how would I know what is non-operating? You already know what is investing, financing, operating. So for example, if I am given that as a part of this PBT, there is an interest income, that's investing. There is an interest charge, that is financing. So what do you need to do in this particular case? When you see the non-operating items, if it is an expense, please add it back. If it is supposed to be an income, please reduce it, subtract it. So what you need to keep the focus is you need to make a scrutiny of the income statement. You need to make a scrutiny of the income statement and see if there is a non-operating income, it's included in the PBT, eliminate it. If there is a non-operating expense that was subtracted, add it back. The focus is not going to be on the interest paid, interest charged. The focus is not going to be on the interest received, interest income. So when you're going to consider the non-operating items, please remember the focus is on the income statement. You don't need the figures which are cash figures. You're going to focus in terms of the income statement. So look at the income statement, scrutinize it, and see any non-operating income minus non-operating expenses plus. There is a profit on sale of a PPE, non-operating, because that's investing. There is a loss on sale of PPE, you need to add it back. It's non-operating. Interest income, any kind of non-operating items adjusted. Within the step number 1, there is another thing to be adjusted. And that is going to be non-cash item. That is non-cash item. I did not say non-cash expense. I said item. The item could again be income or an expense. The most common one is what is called a depreciation, which is supposed to be a non-cash expense. So follow the same principle in this case as well. Follow the same principle. If there is a non-cash expense added, depreciation, if there is a non-cash income. So can you give us an example of a non-cash income? You've done that in your intermediate as well, that if there is, let's say, an amortization of a government grant, because when you consider a government grant, the grant is credited to a deferred income, and the deferred income is slowly and steadily credited to the profit and loss account. And if it is credited to the profit and loss account, it's an amortization of a non-cash income, which is to be reduced. So what's the income statement for both the fronts? For this also look at the income statement. For this also look at the income statement. This is stage one. You need to scrutinize your cash income statement and watch out for any non-operating items and non-cash items. This exercise will translate this book profits into what you can say operating profits. This will translate this into what you can say technically operating profits and partly into cash, not completely into cash. So the idea is that this book profit, which is technically a net profit, is being translated in terms of what we call the operating profit. So in step one, income statement scrutiny, and that you need to consider non-operating and non-cash item. Second stage. The second stage is you go to the step number 2 in this particular case, and in step number 2, what you're going to do, you are going to consider the working capital changes. As we saw in the example just before this, we took the increase in the current assets debtors and the increase in the current liability creditors. Now, watch this carefully. I'll give you some logics later, but let me tell you one thing. At this stage, you will take the movement of all the current assets and all the current liabilities, all the current assets and current liability, but there is a list which is not to be taken here. I will consider the changes in every current asset and every current liability, except the exception means that is not to be considered here. So you will take the movements of all the current assets and current liability, but something which is not to be taken. So let me give you the list of exception. Number one, I will not consider the cash and cash equivalents in this, because that's what I'm trying to reconcile. When a cash flow statement, you're trying to reconcile the opening and the closing cash and cash equivalents. So don't take the cash and cash equivalents as a part of the working capital. Next, in this particular case, when I am considering the working capital changes, I will also not consider any kind of interest payable or any kind of interest receivable. If there is any interest movements, receivable, payable in the balance sheet, don't take that. And because that is not operating in nature, then you don't need to consider any kind of dividend payable or receivable in this particular case, because that is again supposed to be investing in nature. So any interest payable receivable, any dividend receivable payable, not to be taken as a part of the working capital movement. They are not operating movements. And cash we are not considering because that is what we're reconciling. And we will also not consider the income tax at this stage, because income tax is going to be shown separately. So when you are going to consider the working capital changes, please keep your focus very clear that you need to consider all the current assets and current liability, but for things not to be taken, and for the reasons that they are not operating in nature. Tax is operating, but we're going to take care of later. Tax is operating, but we'll take care of later. So don't take the interest payable receivable, don't take the dividend receivable payable, don't take the tax, and don't take the cash equivalents. You take every other current asset, current liability. So when you get this information, where do you pick up all this information from? This information is all going to be picked up from the balance sheet of the company. So get your focus very clear. The conversion of a book profit into a cash profit is going to involve 2 stages. So what are you going to do in this particular case? You are going to convert the book earnings into operating earnings, and then the operating earnings into a cash earnings. So this is going to be done in terms of two stages. As I said, in the step number one, income statement is the focus. Non-operating, non-cash items, adjust them. And the step number two, the focus is on the balance sheet, working capital changes, leaving the list of current assets, current liabilities I've given you. After making these adjustments, you will be able to get the cash profits at this stage, which is technically called a CGO. That's called a cash generated from operation. As we do a question, you get more clarity in terms of things, but you need to remember this procedure, right? I hope I've able to give you conceptually the feature in terms of converting a book earning into a cash earning, the residual. Okay, let me see any questions coming in so far. Yes. So if we reduce interest payable and receivable, it'll not match the working capital balances. Yes, that's what I said. You are not going to consider any movements on this because interest and dividends are non-operating. They are investing, financing in nature. The working capital changes which you're considering is supposed to be related to the business operation. So these are not related to operating. So they're not to be taken as a part of the working capital change. Cash, we are in any case trying to tie up. Tax is supposed to be operating, but we're going to show it as a separate line item. This is the conversion. Now comes the million-dollar question. In order to make a cash flow statement, I'm going to make your life simple. I'm going to make your life simple and I'm going to give you some steps and we're going to apply these steps in a practical illustration as well. Now, as I give you these steps, you will say, no, sir, I don't accept your steps. No, sir, no. You are giving me such a lengthy style of doing a question. No, sir, I will not follow. You see, the thing is very simple. If you've been making cash flow statement and it doesn't tally, that means there is some problem which needs to be cured. You need to take some antibiotics as well. So what I'm going to do, I'm going to give you some antibiotics at this stage. They may seem it's a long duration kind of antibiotics, but trust me, it works, it rocks. Let's do one thing. Let's make your life simple. You can note down these steps. You can note down these steps to prepare a cash flow statement. We'll apply these steps as well, but let's have a look at the steps which we will follow in terms of making a cash flow statement. Let's give you the steps for a direct method separately, and let's give you the steps for an indirect method separately. So if I'm looking at the steps for a direct indirect method, let's keep it differently. So though there is a lot of overlapping in terms of the steps, but let's give it separately. Let's give you direct method and let's give you the indirect method. Now, let's come to the focus points. Please walk through these steps very carefully. We'll do an illustration after this particular steps are over. I would say the very first focus point in terms of making a cash flow statement before you begin the steps is please watch out the balance sheet dates. Please watch out the balance sheet dates in the question. This is your very first focus point. Because since we will be making ledger accounts to capture the movements of inflow outflow, so it is very important that at the first instance you focus on the balance sheet dates because you need to make ledgers. You need to carefully see what is balance BD and what is CD. Because if you don't look at the order of the balance sheet, your BD could become CD, your CD could become BD, then everything BD, CD. So you need to be careful on the balance sheet dates. So that is going to be the very first focus points. Look at the balance sheet date. Then becomes the journey, step number one. So I would say in terms of step number one, which is common to direct indirect method, you will prepare a statement of cash and cash equivalents depicting the position at the beginning and depicting the position at the end of the year that we've already seen at the very start. So being a non-financial institutions, where would the short-term loans and advances come? Don't worry, I'll come to you. Let's first concentrate on the steps. So you need to first get the statement of cash equivalents at this stage. So in terms of the cash equivalents at the beginning and end, you know the comprehensive list now. So what are you going to do? You are going to simply look at the balance sheet. Just look at your balance sheet, scrutinize the balance sheet carefully, and identify the list of items, basically your cash in hand, your cash at bank, your short-term investments, and you're also going to consider a bank OD. I'm putting in brackets, that's a minus. So generally, that's what you're going to do. You are going to pick up the items, go to the balance sheet, just add up the items at the beginning, at the end, get the figures. So at that stage itself, you know the sum total of operating, investing, financing. Next, we go on to the step number 2 after this. Now, as far as the step number 2 is concerned, what do you need to do? You need to make ledgers. You need to make ledgers. Now, when you're going to make ledgers in this particular case, your focus will again be on the balance sheet. You need to make a scrutiny of the ledgers which I need to prepare in the balance sheet of the company. Now, you will not like the step which I'm telling you, because when I'm going to tell you that which ledgers are made, you'll say, no, 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 no. But you have to do it. Yes, 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 yes. Now, in terms of direct method, I am giving you which ledgers are not required. You don't need to make a cash and cash equivalents. You don't need to make a stock or inventory ledger. You're going to make rest all. You heard me correct. In a direct method, leaving these two accounts, it is advisable that you're going to make each and every ledger. Sir, we used to make only those ledgers where the adjustments were given, and then we used to struggle. So don't struggle, my friends. What do you need to do? It might take you a few minutes extra, maybe a 5 minutes extra, but that 5 minutes extra is going to keep your mind relaxed in life in the examination hall. I tell people at times that examinations are not a test of your mental capabilities. It's a test of your nervous system at times. How cool you can maintain. A professional needs to be cool. So what do you need to do? Don't take any tension. So what do you need to do? Leave these two accounts and make all the ledger accounts. You name it, and I'll say yes. Then I will give you exceptions. So you're going to do a question with us, sir, and you're going to make all the ledger accounts. I'll do that. I'll do that. So in terms of this, the two exceptions are common. I'm not going to make a stock account. I'm not going to make a cash equivalence. And there is a third exception. I'm not going to make the current assets and current liabilities ledger. Here I'm going to open the current assets, current liability also. But in this case, I'm not going to open the current assets, current liability, except I will open those 4 ledgers. So there is an exception. You already know the exceptions, the 4 ledgers which you need to open. I will not open any current asset, any current liability, but I will open the interest payable receivable. I will not say 4, rather I will put it as 3, because cash equivalents, of course, I'm not going to open. So there are 3 ledgers which you are going to open. Interest payable receivable, open the ledger. Dividend receivable payable, open the ledger. And there is tax account, open the ledger. So leaving those 3, none of the other current asset, current liability ledger is required. So I've given you a list of the exceptions. Other than this, you all need to open all the ledger accounts. So leave these 2, open everything. Leave these 3 and open all ledger accounts. But these interest payable, dividend receivable, payable, tax is to be opened. So once you've made the ledger accounts, then we are ready with the step number 3, making a cash flow statement. So once this portion is ready, I am done. Because once you made the ledger accounts, you will be clearly seeing the figures of inflows and outflows appearing in terms of the bank account. Because in the ledger accounts, once you've made the ledger accounts, how the ledgers are made is made absolutely in a normal manner. So all the movements in terms of all the bank figures will be very clearly depicted. So what I'll do, I will then make my cash flow statement easily with this. So we will be able to pick up the figures and prepare a cash flow statement in this case, depending upon the method which is required. So this is what I call as a 3-step model. This is simply what I call a three-step model in terms of making a cash flow statement in an easy manner. Get the focus point clear and then follow the three-step model. Get the cash equivalence, that is step one. Make the ledgers with the exceptions, and then we're going to pick up the bank movements in the ledger and we're going to make a cash flow statement. Life jingalala. Okay, so far so good. I think it's time to give you some break as well at this stage. Before we do a question with you and we apply all these steps with you, let's give you a break at this stage. 10-12 minutes. Relax your mind. Don't let your mind run wild. When you're relaxing, just relax for 10-12 minutes, and I'm going to join you in 10-12 minutes. We're going to do a comprehensive question from the study material related to this. So let's give you a 10-12 minutes break, friends. I'll be back in that time. Enjoy your break. Okay. Back, friends. So I guess we can start back. So before the break, we were discussing about the three-step model which you need to apply in terms of making a cash flow statement. I think it's now time to show you the application of these three steps and also the conversion of the book earnings into a cash earnings. So let's have a look at that. So I am carrying one of the illustrations. We'll take a little comprehensive one, I guess. Illustration 11. Yes, I think let's pick up the illustration 11 with you. Let me share the illustration to you. There is illustration 11 in the study mat. So let's have a look at the illustration 11. It says following is the balance sheet for the year ended 31st March X2. And I think you can clearly look at the dates of the balance sheet that you given X2, the current year first, and then the X1, which means that you need to be careful when you take the opening closing balances. So this is the balance sheet given to me. Let's zoom this balance sheet as well. So I guess there is nothing much I want to show you in the balance sheet as of now. So we given the assets on the balance sheet, though we can see that there is a deferred tax asset which is also appearing. And I don't see there is anything much which I need to explain at this stage. But I think one exercise we'll definitely do at this stage is the step number one. Try to see what is the cash and cash equivalents appearing in the balance sheet. So let's focus first of all on the investments. So we can see that there is a cash and cash equivalents for sure. Now, whether these investments are supposed to be cash equivalents or not, that needs to be seen, because unless they are short-term, maturing in 90 days, 3 months, we can't take them. So as of now, no comments. Then as far as the bank OD is concerned, even if the question is silent, I'm going to consider it to be repayable on demand. So for definitely cash equivalents, we'll take them as a part of step one minus the bank OD as a part of the step one. Now, as far as investments are concerned, they are definitely current in nature, but needs to be seen if there is any information given in the additional information. Okay, so let's have a look further on the additional information which is given. So I guess let's focus on the additional information. So now let's see what is given out here. It says we are given a profit after tax for the year ended March X2. But I need a PBT for my starting point. The interim dividends paid is given. The depreciation and the amortization, which is non-cash item, it says during the year is given to me. So this is the depreciation and the amortization, which is non-cash. During the year ended, two machineries was sold for 70 lakhs, and the carrying amount, that is the book value of these machine, is 60 lakh. So we can clearly see that the book value of the machines is 60 and they're sold at 70. So there is a profit on sale to the extent of 10 lakh, which is undoubtedly non-operating in nature. Then there is an income tax which is paid during the year. And then it says other non-current assets and liabilities are related to operations of Kuber, and they do not contain any financing and investing activity. So every other non-current assets and liability, it says do not contain any element of financing, investing. So which means that once I am going to consider even the working capital changes, I need not worry in terms of the fact that there is any investing, financing. Everything is operating in nature. Using the above nature, we need to make a statement of cash flows under the method is very clearly given that we need an indirect method for the purpose. Great. So I would advise, please open the study material in front of you. Keep that illustration 11, because I otherwise might have to keep maneuvering here and there. So what we'll do, we'll just keep the illustration open. I'm also going to keep the illustration open with me. Just give me a second. I also want to keep that illustration in front of me. And you can also keep that illustration in front of you. Okay, I guess I will just open the study material in front of me to start the picture. So just give me a second. I am just going to open the illustration in the study mat. You can also please open the illustration in the study mat, illustration 11. I'll just quickly tell you the page number also once again. Right, so the illustration 11 is on page number 3.143. Page number 3.143 is the illustration. Okay, so let's, I think, begin the journey. I am now going to come back to the inputs. So let's begin the inputs. Let's utilize this space to write. So we are going to first start with the step number 1, the balance sheet dates we've already noticed. So I'm going with my step number 1. We were not given any information regarding the investments, whether they are maturing in 3 months or not. So we're not considering them cash equivalents. So let's consider the statement of cash and cash equivalents. So statement of cash and cash equivalents. So we'll take the balances at the beginning and at the end. So carefully with the order of the balance sheet. We need the balance at the beginning of the year. We need the balance at the end of the year. So if you just have a look at the balance sheet, we can see on the assets we are given the cash and cash equivalents is 460 at the beginning and it is 220 at the end. This is the cash and cash equivalents. And from this, we need to reduce the bank overdraft. So we're given the bank OD on the liability side, and that's 60 and 75. Be just a little careful with the dates. That's all what we need to be careful on when we do the step 1 and the step number 2. So this becomes a total of 400 and this is minus 75. So I guess that comes to 145. Right. So we already know well in advance looking at this input itself. So one thing is pretty clear to me at this stage itself, that when you are going to make your cash flow statements and tally the things, this will be the opening and this will be the closing. So the difference, which you know well in advance, can you tell me what is the decrease in this case? This will be a sum total of the operating and investing activity and the financing activity. So let's quickly take the difference. If somebody can tell me the difference, at least I'll save the calculations part. I think that comes to 255. That is the difference. So we know well in advance. You don't need to show this to the examiner. This is for your own understanding that I know in advance the sum total of the 3 activities will come out to 255. Okay. Now what I'm going to do, I am going to go back to the balance sheet to decide which ledgers I need to make. In step number 2, I've given you that you need to make all the ledgers except the cash equivalents, the inventory or stock, and the current assets, current liability, leaving the 3 exceptions. So let's do one thing. Let's go back to the balance sheet and decide which ledgers are we going to open. So I will coolly open those ledgers systematically. So let me just scrutinize the assets and liabilities with you. Am I going to open the property, plant, equipment? Yes. Am I going to open the intangible assets? Yes. Am I going to open the other financial assets? Yes. Am I going to open the DTA? Yes. Am I going to open the other non-current assets? Yes. You can see that I am giving a yes to all the assets. I'm going to open all these ledger accounts. Okay, then as far as investments are concerned, am I going to open this investments? Yes. Am I going to open the cash and cash equivalents? No. Am I going to open the other current assets? Sorry, this investments? No, sorry, not this investment. Am I going to open the other current assets? No. So I am not going to open any current assets, current liability. So no investments, no cash, no other assets. Am I going to open the equity share capital? Yes. Am I going to open the other equity? Yes. Though technically speaking, I don't need to open the other equity, but I will do something which I'll tell you. So therefore, I'm going to open the other equity as well. So now let's look at the liabilities. Am I going to open the long-term borrowings? Yes. Am I going to open the other non-current liabilities? Yes. Am I going to open the current liabilities, financial liabilities? No. Trades payable? No. Other current liability? No. So I am not given any interest payable receivable. I'm not given any dividend receivable payable. I'm not even given any tax. Though the figure of tax paid is given in the additional information. So I decided that I'm not going to open any current assets, any current liability, including inventory, including cash equivalents, not to be open. So all those ledgers which I have marked, I am now going to open the ledger accounts for all of them. So let's go back and I am now going to open the ledger accounts. So my clerical work slightly starts off. I know this is going to sound a little clerical. Keep making ledger accounts, but then making them is also an art. So I'm just going to pick up the balances of all these ledgers as well. So I'm just going to pick up the inputs, keep the balance sheet in front of you. So we're going to open a property, plant, equipment. I'm just going to keep noting down the figures as well. So my property, plant, equipment at the beginning is 12,500. Be careful with the dates. And my closing balance is 13,000. I'm just going to coolly look at the balance sheet of the company and keep picking up the information. Next, we are given the intangible assets. We're going to go systematic. And the intangible assets at the beginning is given to me, it's 30. And the closing intangibles is supposed to be 50. Then next, I am given other financial assets. So let's open the other financial assets as well. So we've got other financial assets. And in terms of other financial assets, we are given opening is 170. And the closing is supposed to be 145 is the closing other financial assets. Next, we are given a deferred tax asset. So open the DTA as well. So we've given a deferred tax asset. The opening balance is 750 and the closing is supposed to be 855. And then as far as current assets, we're left with other non-current assets. So let's pick up the other non-current assets as well. So we take the other non-current assets as well. So other non-current assets, there is something which I'll tell you later. So other non-current assets opening is 770 and the closing is supposed to be 800. This is the other non-current assets. I think that's it on the asset side of the balance sheet. I think this is done. Then let's go on to the liability side of the balance sheet. So we are given the equity share capital. There is no movements. Now just remember the balances have undergone a change. Now it's a credit balance. So your BD is going to go on the credit side. And then there is other equity also given to me. So we'll open the other equity account as well. And in terms of the other equity, I am given the information. Opening is 8,000 and the closing is supposed to be 12,000. And then we are given the information on the long-term borrowings. So we make a long-term borrowings account as well. So let me call it as LTB. That's long-term borrowings. That's 5,000 at the beginning and it's 2,000 at the end. So this is 5,000 and the closing is 2,000. Just keep on coolly copying the things. Then there is other non-current liabilities as well. So we're going to consider the other non-current liabilities. I'm not given what is that others. So this is 3615 is the opening, and the closing liability that's given to me 2740. I guess that's it. Nothing else is given. I guess I picked up all the informations, I believe. Yes, I think I picked up all the informations out here. So we picked up all the inputs out here. Great. So there's nothing else which is given to me at this stage. Okay, now hear me carefully. What I'm about to tell you is something important now for this question. I want to take you back. So let me tell you what I've done. I've just picked up the ledger accounts and fit it out here. Now, I want to tell you something for this question in typical. In typical, there is something very typical in this particular question, and I'll tell you what. Have a look. There is something which is given in the additional information, and I want to now explain this a little more, which is very typical of this question, the point number 6. Now let's analyze and understand what is given in the point number 6. It says other non-current assets and other current assets and liability. He says other current assets and liability, other non-current assets and liability related to the operations of Kuber, and they do not contain any element of financing and investing, which means the movements as far as non-current assets and liability, others, residuary, is all related to operation. Now, the best input is that when you prepare an operating activities by an indirect method, we never show any inflows and outflow. We only convert a book earnings into cash earnings. Please hear this very carefully. Because in other questions, you're going to see that we might be doing slightly different. So I'm trying to give you a very important focus point. In this question, it says that other non-current assets and liability and other current assets and liability is simply relating to operating activities, nothing to do with investing financing. Now, my mind starts processing this data that when you make a cash flow statement using an indirect method, we do not show any inflow outflow as far as operating activity is concerned, except for the tax paid. Except for the tax paid, no other inflow outflow is presented in an operating activity. So now the question what comes into the mind is that if all this is relating to operating activities, let me rather put that question to you. Do you see any point in terms of making this other non-current assets and other non-current liabilities? Do you think I should capture any cash movements in these ledger? If these movements are purely operating in nature, in any case in my indirect method, I am not going to show them as a part of my cash flow statement. So will they be taken as a part of the ledger accounts, or do I consider them as a part of the changes in the working capital? I know they are not working capital. But my objective would be to convert a book earnings into a cash earnings. So my question, let's get your input. Am I supposed to make a ledger account for this other non-current assets and other non-current liability, or should we take it as a part of the conversion of the book earnings into cash earnings? You tell me the answer. So are you going to consider this as a part of the ledger accounts, get the bank movements, or are you going to consider this in a conversion of a book earnings into a cash earnings, since they're all operating movements and we do not reflect any cash movements in operating activities? And that's right. So in this particular case, I am now going to cut this ledger. So this other non-current assets deleted, this other non-current liabilities deleted, and I'm just going to put a note for your reference later. Let me also ask you another question. If these ledger accounts would have included investing financing activities, do you need to make the ledger accounts? Undoubtedly, yes. So the moral of the story goes like this. We can say that if this other non-current assets or non-current liabilities includes movements of operating activities only. Leisure not required. Leisure is not required. So what are we going to do in this particular case? You can comfortably take this as a part of converting the book profit into a cash profit. So you can directly take them as a part of the conversion of a book profit into a cash profit. But if they would have included, let's say, any investing activity or any financing activity, then the leisure is required. Then the leisure is certainly required in this particular case. And I think you hope you got the logic as well. Since in the operating activities, we do not reflect the cash movements, therefore, we are not making this leisure. So that point number 6, which is given to you as an additional information, is very vital in order to decide that these leisure accounts are not to be prepared. Great. Let me just come back on the question and give you some other inputs also out here. I guess we can have a look in terms of some other inputs also in this case. Okay, then I see something else as well. I can see that there is some more residuary in nature as well. And what is that residuary in nature? There is other financial assets as well. And even that other financial assets is supposed to be other, non-current assets in nature, which is again operating in movement. So I think we can delete this portion as well. Even this is not required. The rest, I think this is required, and this is required. Great. So these leisures have got eliminated only specific to this particular question. It may not get eliminated in other questions. I hope I am very, very clear on my agenda. That's one. Now, second focus point. In terms of the second focus point, if you look at the question, I'm already given a profit after tax, and I'm also given the figure of tax which is paid. So getting my starting point is not going to be a problem at all. But I would advise in this particular case, let's go back to the question. And let's have a little read in terms of what is given. Now, I am given some information out here which I want to reconcile at this particular stage. I am given a profit after tax is supposed to be 4450. I'm given the profit after tax is supposed to be 4450. I would advise, if in the question the PAT is not given, what you can do when you consider the other equity and you compare the closing versus opening, you will get the retained earnings for the current year. So when you are going to make this particular thing, so you are given the other equity. So I assume that other equity, the difference in the opening and closing is not the profit earned during the year, but it is supposed to be a retained earnings during the year. I would advise you must reconcile. That what is the retained earnings and what is the figure which is the profit after tax. Because that could give you informations that the company might have distributed some kind of dividends as well. I guess you got my point. No, sir. Can you put that once again to us? I'll just put that inputs once again to you and tell you what am I about to tell you. Just have a look once again very carefully. If you look at the other equity, let's go back and look at the other equity as well. Let's look at the other equity in this particular case. You can see the difference between the opening and the closing is supposed to be 4,000. This is what you can say is the retained earnings. This is what you can say is the retained earnings. It's not the profit earned. It is not the profit earned. It is supposed to be, you can say, the profit which is retained. Retained means it is a PAT minus any appropriations in the form of dividends, for example. You must do a reconciliation in every question. This is something which is pertinent. Even if the examiner tells you that there is a PAT, I would say it's okay, but I would still do a reconciliation. You know, your opening is 8, your closing is 12, the retained earnings is 4,000, and what is the profit after tax? I think it was 4450. So if you earned a profit of 4450, but your other equity tells you that you retained only 4,000, then what happened to that 450? This 450 is a hidden information that you must have paid some dividends during the year. I hope you got my point. So which means before you start making ledger accounts, many people get into the trap and say, oh, I am already given a PAT. Sir, I don't need to make my reserve and surplus. I'm not going to make my other equity account. I would insist you must at least do a reconciliation. Because you need to compare what is the profits after tax given in the question and what is the retained earning, so that I can get the hidden information that there is a dividend paid which becomes financing in nature. Focus. Okay. So I think we've decided which ledgers are to be eliminated, and we have decided the reasons for the elimination. We've decided to do a reconciliation as well. Now we are ready in terms of making ledger accounts with you. Now, in this question, I am not given an income statement, but let me tell you something in generic, that if you are given an income statement, I am going to first look at the income statement. Any information relevant for the ledger account, I'm going to fit it out here. And then I'm going to go to the additional information, and then I'm going to fit it out here. So when you are going to make your ledger accounts, you need to keep two focus points in mind. If you're given an income statement, make a scrutiny of the income statement. See if there is any information which is relevant for this ledger. Please fit it out here. And then scrutinize the additional information and fit it out here. In this question, I am not given any income statement, just a balance sheet is given. So I'm going to directly start with my additional information. So let's do one thing. Let's go to the additional information. And I am going to now complete my ledgers. Let's focus one by one on additional information. So let's start fitting in the information in the ledger accounts. The profit after tax is 4450. That reconciliation done. Interim dividend is 450. So does this mean that this is what is given in the point number 2 of the additional information? Yes. Sir, this was already given in the question. Why did you reconcile? Well, if this was not given in the question, this could have been hidden information. So I would advise that if it is given or not given, you must reconcile and get the reconciliation. Okay. Then it says point number 3, there has been a depreciation on the PPE. So when you took a depreciation on the PPE, in the PPE ledger, you put by profit and loss, and the depreciation is to the extent of 500. Then next, I can see intangible assets. There is an amortization. So by profit and loss, that is the amortization, and that is to the extent of 20. So these figures are all in lakhs. So just picking up the additional information, fitting it into the ledger accounts. Then it says in point number 4, during the year, that is at the end, 2 machines are sold at 70 and the book value is 60. So you sold the machines, that is buy bank, at 70, and there is a profit on sale that is to the extent of 10, because book value 60 is sold at 70. And then it says taxes paid, but I think we don't have any tax account in this case. Since we don't have any tax account, I think we'll take care of the tax paid information later. So remember, the dividend paid and the tax paid, we're going to directly consider in the cash flow statement. And point number 6 is done. So we've taken care of all the inputs which is given in the additional information. Now what do you need to do? Apply common sense. And you need to see that how the ledger accounts are to be closed. Just watch the movements and close the ledger. So let's, I think, start closing the ledgers. You need to help me with the balancing figures. So is there any balancing figure coming on this side? Yes. And can you please give me the balancing figure as well? So there is a balancing figure, and you can logically decide that this must have been a purchase of a property, plant, equipment. So we're going to take that bank 1060. Great. And then there is intangible assets. We are getting a balancing figure again on the debit side. I guess that is 40. So this must have been a purchase of intangible assets as well. So we'll keep applying common sense and get the information. This is gone. A deferred tax asset. Now, a deferred tax asset is again cash movement, non-cash movement. You already know this input that as far as a DTA is concerned, it's a notional asset in nature. If it is a notional asset in nature, what are you going to do in this particular case? Are you going to capture the movement as a part of the non-cash exercise? Yes. So I would say I will again capture this movement as a part of the non-cash item. There is a non-cash movement. So let's see what is the increase in terms of DTA. We'll take care of that. This is, I think, 105. So we don't need to make a ledger account typically again for this because DTA is not any cash movement. So we can take that as a part of adjustments, converting the book earnings into cash. Equity share capital is already agreed. There is no movements. Other equity reconciliation is done. Then long-term borrowings is getting reduced by 3,000. There must have been a payment which we can say is back. And I think that's it. All the ledger accounts are pretty much done. Now we are ready to make a cash flow statement, but before you're going to make a cash flow statement, we are going to do another exercise. I'm saying a lot of things in between because this is what you need to be careful as you're going in each step. Now, once you're going to make a ledger accounts, my advice is before you make a cash flow statement, my advice is do a scrutiny of the ledgers. C, identify for every ledger, is it investing, financing, operating in nature? Write it on the top of the ledger so that once I make my cash flow statement, I can track the movements. So as far as the PPE is concerned, we know it is investing activity. Intangible assets, we know is it investing activity. And as far as other financials is concerned, we're going to capture this in the book conversion, DTA in the book conversion. Equity share capital is financing activity, though there is no movements. Other equity, we've got the dividend, which is financing activity. And let's also remember that there is a tax paid also given in the question, which is 450. That is operating activity. Just keeping a track so that we don't miss it out. Long-term borrowings is financing, and this is again taken in the conversion. So I've just on a very safe side written down that which ledger pertains to which activity. I think now we are ready to make a cash flow statement. Let's begin with a cash flow statement indirect method. Trust me, the steps are very important. You must do this question by your hand after the session today, maybe in the evening or whatever, but do this question by hand, do more practice, you're going to get more expertise. So let's make a cash flow statement which is using an indirect method. In this particular case. So we're going to start with the cash flows as far as operating activities are concerned. And I've already given you your starting point is going to be PBT. So we read first of all the profit before tax. Now, another small little input which you need to keep a track on is as I need to get a PBT, remember I need to add PAT plus the tax charged. But in this case, I'm not given any income tax in the balance sheet, which means whatever is paid is also charged. So the payment and the charge is equal. So we're going to start with a PBT as a base. So we've got a PAT that was 4450. And what was the figure of tax paid? I guess 450. So we get my PBT that is to the extent of 4900. That becomes my starting point. Now, as I said, your focus is going to be non-operating, non-cash. We'll focus in step one, non-operating, non-cash, and then the changes in terms of working capital. But there is something which is non-current in this case as well. So I'm writing step number 1, but don't tell the examiner this is step 1. This is for your understanding. I'm taking the step number 1 in which I need to consider, first of all, non-cash items. And we're going to make a scrutiny in terms of non-cash items. And we're also going to make a scrutiny in terms of non-operating items. Now, as I said, you're going to look at the non-cash and non-operating items in the income statement. But the problem is, in this question, we are not given any income statement. So in order to get the non-cash and non-operating item, I'll have to go back to the ledger. Look at all the ledgers where the profit and loss is written. Wherever the profit and loss is written, identify is it non-operating or not. So let's go back to the ledger and identify that the item is what nature. So let me just put a red color on that. As far as the profit and loss is concerned, depreciation, this is non-cash in nature. As far as the amortization of the intangible is concerned, this is also non-cash in nature. And as far as the profit on sale of the PPE is concerned, this is non-operating in nature. So you need to scrutinize each and every ledger account, identify the items which are non-operating and non-cash in nature. Then I guess any other P&L figures which you look at, I don't think so there is anything else. So this is this, and in fact, this is also which is something which is non-cash in nature. So I think as a part of the non-cash items, you've got depreciation, amortization, DTA movement, and as far as non-operating is concerned, you've got the movements in terms of the profit on sale. Let's begin the data. So once we made a scrutiny, we get the input. So what was the non-cash item? Depreciation. How much was the depreciation, by the way? How much was the amortization? If you can just give me the figures. Tax paid is 105, is it? Oh, my mistake. Tax paid is 105. I'll rectify that. Thank you. So tax paid is 105. So this is going to become 4555. Okay, my mistake on that. Okay, so what was the figure of depreciations and the amortizations in the ledger? And we can also take the deferred tax asset movement as well. There has been an increase in the DTA. So what is the figure of amortization and depreciation? I think it is 520. So depreciation you add, amortization you add, and I guess DTA. Did you say the tax paid is 105? I think that was a DDA, dears. I think somebody has given wrong information. What is that? Oh no, it's 105 only. My mistake. Yes, it's 105. That's okay. Okay, so what was the DTA increase? The DTA increase is to the extent of 105 again. So we've got 105, that is a DTA increase as well. Now the question rises, what do we do with this DTA increase? Block the money. So this is going to be subtracted. So what I've done, I've taken a scrutiny in terms of the ledger accounts, captured all the movements in terms of non-cash, non-operating in nature. Now it's time to look at the second step. Let's look at the, I think I've taken A and B together. Okay, so this is non-cash, and I would say this is also non-cash. The non-operating, there was, I think, a profit on sale of PPE. So what was the profit on sale of the PPE? That was 10. So the profit is going to be subtracted in this case. It's a non-operating income. Right, so step 1 is done. We've captured the non-operating and non-cash items. Now let's go to step number 2. Don't give this to the examiner. Don't start writing step 1 and 2. This is only for your understanding that the conversion of the book earnings into a cash earnings is going to take place in stages, and that is non-cash, non-operating, and then it is working capital changes. But this is an exceptional question where there are certain movements which are not a part of the current assets, current liability. It's non-current, not exactly a working capital, but since we need operations movement we're taking them. So let's now go back to the balance sheet first. Let's pick up the current assets and current liability. So go back to the balance sheet now, see the movements in the current assets. So I guess in terms of the current assets, we are given, first of all, there is a decrease in the investment. There is a decrease in the investment that is from 2,500 to 2,300. So 200 decrease that would be added. Then cash equivalents not to be taken. Then other current assets have shown an increase, I guess 110. So that would be reduced. There is an increase in terms of other current assets. So that's it on the other current assets. Then we go to the current liabilities. So we given a trades payable increase of 60. Your trades payable is increased by 60. That would improve your liquidity. That's a plus. Bangori is not to be taken. Other current liability is again an increase of 100. So increase in other current liabilities, that would also increase your liquidity as well. So all the current assets, current liability movements are captured, and now we need to capture the movements in terms of those ledgers which we did not prepare. So let's capture the other movements as well. So we can say in terms of other financial assets, 25 down. So 25 is the decrease in other non-current financial assets. So this decrease is going to be a plus. Next. So we've got other non-current assets as well, and that is to the extent of increase of 30. That's going to be minus. So increase in terms of other non-current assets. I guess rest everything is done. So all the movements are captured. Now we can get what we technically call cash generated from operations. So can you please get me the figure? What is a CGO, the cash generated from the operation? So do the plus minus and give me the figure of what is the CGO. So do the plus minus and tell me what is the cash generated from the operations coming in. Other non-current liabilities, we have taken that, I guess. Did we miss out anything? Oh, yes. Please give me the change of this item as well. There is a decrease in the other non-current liabilities as well. So we'll adjust that decrease in other non-current liabilities. What is the figure of the other non-current liability as well? Give me that figure as well. It's went down from 3615 to 27140. So what is the amount? That comes to 4130. No, what is the figure? This is 875. Okay, so this is 875. This decrease would be supposed to be a minus again. Now let's get the figure of cash generated from operations. So take all the plus minus and get the CGO. Is it 4130 what I am getting out here? Is this coming to 4130? What I am given the inputs? Is this 4130? I'm not using my calculator. My calculator is gone for an impairment. So you'll have to do the calculations to me. Just check, is this 4130? Is that coming? Everybody is relying on others to do the calculations, I guess. He will do it. Yes, it is 4130. That's great. Somebody's saying 4330. Are you sure? It's 4330. I guess it should be 4130. That's what we have done. See if there is any kind of error. I'll just quickly check this. 4450. Tax paid, that is correct. So, okay, that's okay. It's coming to how much? You are getting 4330. Let's see. So 520, this is correct. Then 105, this is correct. I'm just trying to reconcile 25 and 30. So 25 and 30, 110, 875, 110, 875. That is right. 160, this is correct. And as far as the investments are concerned, oh, the investments is not taken out here, but it's neither a part of the cash equivalents. Oh, my mistake. I've done a small little error. Investment is not to be taken. My mistake. My mistake. It is investing activity. How can I forget that? That's okay. So this is going to be taken in the investing activity. So are we getting 4130 now? Yes. That would be investing activity, my mistake. So from this, you are going to reduce the tax paid. I think it was 105. So this is what you're going to consider as this is operating activities in nature. So this comes to, I think, 4025, if I rightly remember, correct? Calculate. Yes, 4025. Wow. So the operating activities are done. Now scrutinize the other ledgers for investing, financing, fit them. So let's take the other ones. We are now given the cash flow, which is investing activities. We're also given the cash flows, which is financing activity. Run all the ledgers and pick up the informations in those cases. I think before we forget, there is a sale of investment, is it? The investment was degrees, yes. There is a sale of investments which we have put it out there, that is 200. Now let's make a scrutiny of all the ledgers, see what other information is to be fitted in. So we've got a purchase of PPE, we've got a sale. Sale is 70, purchase is 1060. Purchase is 1060, sale is, I put it the other way around. The purchase is 1060 and the sale is 70. So this is a purchase of PPE and this is an sale of PPE, that becomes an inflow. Keep picking up the information from the ledgers. Intangible assets purchase to the extent of 40, that becomes an outflow. So purchase of intangible assets 40. So let's consider the purchase of the intangible assets as well. And let's see more inputs out here. PP done, intangible done, this is all done. Share capital movements, dividends we will take. These are financing activity. So I think we just need to consider the dividends as well as the long-term borrowings. So let's consider the long-term borrowings and let's consider the dividend paid. The dividend paid was to the extent of 450 outflow. What was the long-term borrowings repayment? So 25 is current asset and not non-current. Please clarify. What was the 25? I didn't get you. Which figure of 25 are you referring to? And the long-term borrowings repayment is 3,000. So there is a repayment of long-term borrowings 3,000. So we can take this total as B and we can take this total as C. Give me the figure of B and C. So do we need to present changes in working capital like you presented, or we can present it as change in non-current assets and liability? Well, this has been a typical question where we are considering movements other than a working capital as well. Generally, when you capture the working capital, it's only current assets, current liability. But in this case, since the other non-current assets, other non-current liability is operating in nature, we have captured it as a part of the working capital. But technically, in the exam, you need to write down working capital changes. Okay, so let's see what is the total of this B and C now. And then we can add up ABC. So B is coming to 830 negative. This is a cash flow used in the investing activity. And let's consider the C as well. I think that's 3450 negative undoubtedly. Now let's add up A plus B plus C. So just add what is the total of A plus B plus C. So let's add up the sum total of A plus B plus C. See what it is. Is it positive or is it negative in nature? And then accordingly, we decide the inputs on that. So it's coming to negative 255. So this is negative 255. So we can say this is supposed to be decrease in cash and cash equivalents. This is a decrease in the cash and the cash equivalents. Now we already know the opening and the closing balances. So give me what was the opening balance of cash and cash equivalents. What we had done in step number 1 initially, and we should be able to match it with the closing balance of cash and cash equivalents as well. So see the step number 1, opening balance of cash and cash equivalents. So we got the opening balance that was 400 and the closing is 145. So I think this ties up with my cash flow statement, which means we have done it absolutely correct. So this is a good question because it is a little off-track kind of a question, especially when it comes to that other non-current assets and liability. Otherwise, typically the steps, of course, remains the same. So this was the technique, the model, which we need to adopt in terms of making a cash flow statements with you. Let's try another simple question. I think we got another 10, 12 minutes. We can maybe do a small little cute question. Let me also tell you that in this particular standard, you're also given a question which is on a consolidated cash flow statement, but I intentionally did pick it up because unless you've got a little knowledge on the consolidation, I didn't do that. So my advice would be you can come back to that particular question once you've understood the consolidation concept, then you can come back and try that question which is on a consolidated cash flow. So 25 is current asset and not non-current. Please clarify. 25, which 25 are we looking at? This is other non-current. I think it is non-current. Can somebody just verify that? Is that 25 supposed to be non-current? I think it is. When I looked at the balance sheet, I think it was non-current. Just see the balance sheet. I guess that is non-current in nature. So this is, yes, it is non-current. You can see other intangible assets. It is other, sorry, it's other financial assets which is given. Okay, I don't know which 25 you're talking about, but I think whatever you've done is perfectly correct, I guess. Okay. Now I think let's take you to a small little question. Bigger question is done. This was illustration 11. Now I guess we can have a look at a small, cute little question as well. This is going to be simple to do. Let's close on a sweet note. This is something similar to what you have done at the intermediate level as well. This is where, we used to begin with our cash flow statements at the intermediate level. And today in the final, we're closing with that sweet kind of question. So let's have a read out here. And didn't I tell you that when you're looking in terms of, this is for the direct method now, because we've done indirect. And I told you that, when you look at a cash flow statement, it is nothing but typically, you can say it's like a cash book, which is being organized in the form of operating, investing, financing activity. So it's a more organized kind of a statement. Let's read. The following is the summary of the cash account, and we need to make a cash flow statement for the year ended March X1 in accordance with the direct method, that is Ind AS 7. So very clear, we need to apply the direct method. So I think what I need to do, I need to first of all identify the opening cash equivalence. So we know the opening cash equivalence is 50, and we know the closing cash equivalence is supposed to be 150. So I already know that my answer, that is increase in the cash and cash equivalents is going to be to the extent of, you can say, 100. The sum total of operating, investing, and financing is going to be equal to 100. Next. So we can now just identify the activity. It says issue of equity shares, that is financing activity. Receipt from customers, that is operating activity. Sale of fixed assets, that is investing activity. Payment to creditors, that is operating activity. Purchase of fixed asset is investing activity. Overhead expenses is again operating activity. The payroll is again operating activity. The tax payment is again operating activity. It's just like, identifying the activities in this case. Dividends is supposed to be financing activity. Repayment of the bank loan is also financing activity. So one can easily organize the data and you can get the inputs, what is investing, financing, operating. I don't think so. You'll ask me to make a cash flow statement for this question. Say no. So how are the foreign components presented while consolidation? Well, consolidation is something which you're going to learn later. I will not insert the consolidation concept because without having idea on the concept of business combinations and the consolidation standards, you may not be in a position to make a consolidated cash flow statement. Fortunately, unfortunately, I don't see that there is any question on a foreign subsidiary. You've got to make a foreign a cash flow statement in a foreign, you can say foreign conversion. It's not there, but in any case, unless you have done consolidation, it's a little difficult to get that feel. So let's do that. Very true. I think that's manageable, but we can just still show you the answers, what we have identified out here. This is pretty simple and straight indeed. So you can just have a look at the inputs, how the things have been organized. That is pretty simple and straight. And of course, the closing is being matched. So the closing figure is being matched out here as well, that you can very carefully see that this is the opening and the closing matched. I think that's what is there in terms of the cash flow statement. Pretty easy, standard. There are a few illustrations and one or two questions. One question which is there, I think one illustration and one question at the test your understanding, which is talking of a consolidated cash flow, but I would advise that can be done only after you're done consolidation for a better understanding. Otherwise, this is done. There are more illustrations, a few, one of them, which is you can practice. I have tried to cover the maximum concepts which we could cover in terms of cash flow. So please do practice this question by your own hand to get a more gripping of the concept. Now let's see if there are any questions at your end. Let me see if there are any questions coming in. Sir, I have always been doubt in unrealized foreign cash and cash equivalents reconciliation. Okay, I think everybody's a bit asking about the cash reconciliation on this. Okay, I'll tell you. Let me just add on one inputs to you. So I think let's talk on the inputs in terms of the foreign exchange gain loss. If there is a foreign exchange gain loss arising on account of, let's say, a investment, you just need to do a simple thing. If there is a foreign exchange loss, it's an unrealized loss, add it. If there is a foreign exchange gain, then you need to subtract it. So once you get your cash and cash equivalents, once you get the cash and cash equivalents at the beginning as well as at the end. So what do you need to do? This is all unrealized in nature. So if this is unrealized in nature, you need to basically reverse the unrealized gain or loss. Losses, add them back, gains, minus them. So you would get the position at this stage. Secondly, when you consider the cash flow as far as operating activities is concerned, and you start with the book profits as a base. Now this book profit is again after charging the exchange gain or loss, which is unrealized or non-cash in nature. So what you need to do in this case, add back the foreign exchange loss and you need to reduce the foreign exchange gain. This is what you need to do in terms of the foreign exchange gain or loss. So I think that's what I think somebody has asked. So if you got any kind of foreign exchange gain loss, it is unrealized in nature because it's just a restatement gain or loss. So what do you need to do? Adjust it in the book earnings for indirect method. This is when you are going to follow the indirect method in operating activities. If it is a direct method, of course, it doesn't hit your operating activities. So, but in terms of cash equivalents, just reverse the inputs. Okay, another question I'm getting. So I have a doubt in terms of converting a PAT into PBT, as tax components will include both the current tax, which is paid, and also deferred tax. Well, when you are going to consider a PBT from the income statement point of view, you need to add the total tax expense, which is current and deferred tax put together. Because in the income statement, when you take a PBT, then you reduce a tax expense and you get a PAT. So to reach that starting point, both taxes would be adjusted. In this case, in any case, what I did, I have just simply taken the impact of the figure because he said a profit after tax, so we are considering it is just after the payment of taxes. Nisha, so can you please repeat that again? Simple. The book earnings is after charging loss, add it. After including gain, reduce it. Why? It is non-cash, it is unrealized in nature. And when you're considering your cash equivalents, if it pertains to investments which are part of the cash equivalents, what do you need to do? You need to again add the loss, reduce the gain. Basically, throw it out. Because something which is not to be a part of the cash flow statement, any gain minus any loss add. That's the simple concept because it is unrealized in nature. We need only cash movements. Great. So P&L included in the investment bank. P&L is included. No, this would be typically only if you follow indirect method. If you're following a direct method, then in that particular case, this movement will not get captured in the cash flow statement because there you take only cash movements only. Okay, so I think let me just check the other questions also. Okay, that's great. Right, friends, so I think that brings us to the end and we're done with the cash flow statement. We'll see you again in the near future. Once the call comes, I will see you once again. It was pleasure meeting you all once again today. So please revise the standard and we will be in touch. Thank you very much. Bye-bye and take care. Have a good week ahead.
Thank you, sir.
Thank you.
Thank you, Ashok ji.